as Helen said, my name's Jannah. I was an originating member of the Digital Pound Foundation, and I will hopefully also share a little bit of insight on this topic and introduce, why we're here today talking about digital sustainable finance at the Digital Pound Foundation and how it's sort of actually inextricably linked to the origins of the DPF. I'm going to allow the panelists to introduce themselves briefly. We have a substitution today. You may notice that this is not Madeline Boyce. This is Victoria Thompson, also an originating member of the DPF. Unfortunately, Maddie's flight has cancelled, and Victoria's very kindly stepped in as a substitute. So, Victoria, a few quick words on yourself, and then go along.
Yeah, thanks, Jannah. Hopefully I'm a useful sub that's pulled off the bench, a bit like Ole Gunnar Solskjaer for Manchester United. We do miss him. I'm a technology lawyer by training and background, and for sins in a previous life, I've been helping banks innovate for the past decade and stopped counting. And I kind of fell in love with what the potential of distributed ledger technology could do in the future of sustainable finance during the pandemic. And now it's a large part of my time with the company that I run, Orora, and the work that I do with UCL and the Distributed Ledger Science Foundation that I'm a fellow at there. So that's me.
Hi, I'm Kikun, a senior lawyer here at Clifford. I'm in the regulatory finance practice, and we advise right across the whole spectrum of the digital assets industry. So we advise sort of regulators as well as service providers and adopters.
Hi everybody, my name is Devina Paul. I am Chief Financial Officer and Deputy CEO of Zumo. We are a digital asset platform. We offer crypto as a service to institutions of all sizes. And through our own net zero journey a couple of years ago, we realised what we'd come up with is something that we could productise that would allow institutions to measure, report and address the carbon impact of the digital assets that they are using.
Good morning, everybody. I'm Richard Baker. I'm the founder and CEO of Tokenovate here in the UK. And Victoria, thank you for the football reference. I'm a West Ham fan, and we don't seem to have any useful substitutes on our bench at the moment. So it's painful to listen to other successful team stories. We're a 3-year-old business that is using distributed ledger technology to automate derivative trading. And so we focus on over-the-counter derivatives. And as part of that process, we tokenize collateral asset, enable it for collateral mobility so that initial margin, variation margin, and settlement can be done through smart contracts.
Thank you all. So when I was thinking yesterday about how to introduce this topic and its relevance to the Digital Pound Foundation, as I mentioned, it became clear that I'd have to go back in time. And so it was quite fortuitous that we had Victoria willing to step into the panel today, because it really all started for me in January 2020 with a coffee that I almost cancelled with Victoria, with whom I worked at the London Blockchain Foundation. And so we met for a coffee at Barclays Rise. Victoria was about to leave Barclays. And she said to me at some point, what do you actually want to do? And I said, well, really what I'd like to do is overthrow the banking system and make financial services work for the people. And I said, what do you want to do? And she said, oh, I'm going to leave Barclays and create a startup looking at tokenized IP. And the spoiler alert, neither of us actually did those things. But Victoria also said, I'm doing some work with this group called the Whitechapel Think Tank, and we're looking at a paper on payments and privacy, and you should join. And I said, well, I know nothing about payments and privacy. All my background is in capital markets. And she said, well, it's an interesting group of people, and I think we could do something with them. So come along. So early February 2020, just before the pandemic really kicked off, I went along to my first meeting at the Whitechapel Think Tank, and sure enough, it was an interesting group of people. And they did want to produce a paper on payments and privacy, but their hearts didn't really seem in it. And then lockdown happened, the pandemic happened. Actually, Victoria and I ended up working on a startup called Lightning Aid, an initiative with Railsbank to address the needs of mutual aid groups. in Southwark, where I lived. One of the early challenges that arose with mutual aid groups was their inability to take payments, to make payments, to receive funding. Southwark Council said, you know, if you can figure out a way to make this work, then that's legal, then we'll give you some money to actually disperse, not to pay us, unfortunately. And so we collaborated with Wales Bank on this pilot of a payment system for unincorporated entities and the people who were involved in them. And this kind of led us to discuss, you know, some of the challenges around inclusivity in finance, around what we need out of a financial system to make it work for people and the planet and things like that. We went down a lot of rabbit holes that year. I mean, at one point we were applying for a grant with UKRI and some random Spanish academics to look at a tokenized insurance-linked bond issuance, I believe, and earthquake insurance. But anyway, Digital Pound Foundation, on the other hand, so while all of this was ticking along, we, the Bank of England's discussion paper on the digital pound came out, and this was about April 2020. And the group of people who were not terribly enthusiastic about payments and privacy suddenly developed an extreme interest in the digital pound and submitted what must have been one of the more coherent responses to the discussion paper at the time, because it turned out the Bank of England was actually quite keen to talk to us, since we weren't just complaining about how the digital pound was going to, you know, violate everyone's privacy and lead to ultimate state control. And one of the members of that group, Lee Schneider, said, there's this whole digital dollar project going on in the US. Why don't we do something similar in the UK? So Victoria, once again, Lee, Jeremy Wilson, who is the original chair of the DPF, and I basically wrote a paper entitled the DGBP Initiative, Digital Pound Foundation sounds much better, and started working with a group of companies to look at what this thing would look like. It's great to see so many of them in the room today. So we had Avalanche, Accenture, Ripple,
HSF.
Yep. And that was really how the Digital Pound Foundation happened. And I think an important thing about this story is that all along, our goal was not really just to focus on the digital pound and on payments. It was to look at how a digital pound, in both publicly and privately issued forms, could support actual innovation. And that actual innovation can take many different forms. And if we look at many of the public policy objectives that, for example, the government wants to achieve in terms of the transition to the digital economy, improved tax collection, improved benefits delivery, these are all things that have at their foundation a need for digital money. This is the foundational technology that will enable the delivery of many of these objectives. And when it comes to digital sustainable finance, obviously, you know, this is a key critical area which we can't really progress unless we have digital native settlement assets, like the rest of digital finance. So why digital sustainable finance, and why today? And I'll keep it quite short on this occasion. If we look at, you know, the increasing regulatory drivers for ESG, for embedding reporting, for embedding sustainability, outcomes in financial instruments, these are very difficult to achieve with the technologies we have today. So you have a green bond issuance, for example. If the issuer doesn't deliver on the promises in the prospectus, we'll often only find out 18 months later because, you know, corporate reporting is 9 months after company year end, and that's way past the fact. If, on the other hand, we can have a digital bond issuance that's linked to Internet of Things sensors that can monitor in real time what's happening with the performance of the underlying project, and alerts in real time, and smart contracts that can then govern the payouts and incentives associated with that, then we can start to deliver real sustainability outcomes in real time. And of course, for this, we need a digital settlement asset in the form of a digital pound. But without further ado, we have a fantastic group of panelists today. I've kind of said my bit. all of them are practitioners working in this space. This is not hypothetical. This is real and happening today. So I'm going to invite them all to talk about the work that they're doing and what they're bringing to life in digital sustainable finance. And I'll start with you, Richard.
Thank you. So I introduced Tokenovate as a company that is focused on over-the-counter derivatives. And our day job is in building out a workflow engine that uses smart contracts to take a ISDA-based over-the-counter derivative and effectively manage the economic and legal pathways of fulfillment. So we want to de-risk how does a set of counterparties enter into a master agreement that could be for an interest rate product. I'm actually going to relate it now to a voluntary carbon credit or a biodiversity credit. But really we want to remove the uncertainty in how the obligations of that agreement get fulfilled. So over the last year or so, we've been working on the international topic of voluntary carbon credits. I would say, firstly, presently this industry is suffering from a lack of standards. So we have very high expectations of the COP29 event in the coming weeks. There's a number of very important discussions. We have the International Voluntary Carbon Credit body, ICVCM, which really represents sell side of the industry. We have VCMI, which really represents the buy side of the industry, and then science-based technology, and a couple of other initiatives who meet really to try and tackle the final definitions of Article 6 of the Paris Accord. And industry is struggling presently to really pay attention to how we do focus on long-term carbon removal, because we don't really have a solid foundation of standards that then methodologies for removal can be assessed against. So it's actually very difficult for transition finance to come into worldwide voluntary carbon markets at the moment because there is a lack of definition at the base layer. I do think as we go into next year, we're going to see those standards, and we see some really good assessments of various methodologies on registries around the world at the moment. I'll animate this in the fact that we've been working with the UK peatland code, woodland code. We have a project that we've been tokenizing up in Scotland. It's a peatland asset. And here is, several 100,000 acres of land. So there's property law that is underpinning that. Who owns that asset? There's a project developer in on that asset, effectively re-heathering the land, re-flooding the land to return the peatland asset back to a carbon sink. So at the moment, with no heather on the land, it emits methane and contributes to greenhouse gas. When you re-heather it, it stops emitting methane. When you re-flood it, it returns to being a long-term carbon sink, so it can become a 80 to 100-year high-integrity carbon asset. I need to get project finance into that. So, we really look at how we can use digital technology to prove the provenance of that asset. That asset has to be invested in over a long period of time. So that project will roll out over about 20 years. So every year there's a vintage release of acreage that makes up the carbon removal of that particular overall project. So we need to flow trade finance in exchange for a voluntary carbon removal output measured in metric tons. And effectively buyers want to know that I can trust that I know where that location is, I know who the project developer is, I know who owned the property. And so we try and spend our time bringing a number of standards together to tie up a provenance record, a golden record of that asset, and we enshrine that into a token, and we enable that then to look like, effectively, a claim over a bearer instrument. And that becomes attractive when you start to think about that through the lens of an over-the-counter swap. I now might be able to swap my transition finance investment into that asset for a long-term output. And what everybody in capital markets struggles with often is, unfortunately, the maintenance events of these long-term contracts. If I'm in a 30-year bond, or I'm in a 10-year interest rate, or now a 90-year carbon credit project, or 30-year removal project, it's all of the daily maintenance events, now along with the reporting and rating that needs to happen on these projects, that really would benefit from automation and certainly benefits from an e-currency to support all of the activities. How do we incentivize the actors associated to those types of projects around the world to pay attention? My last piece on this would be to say, I was across at the New York Climate Week conference 2 weeks ago, and really it's not till you listen to the chair of Indigenous people talking. So heartfelt about, we have 5% of the world's natural resources, tropical forests, biodiversity, nature reserves, that produce most of the oxygen that 95% of the planet, the people on the planet, use. And so we really need to start to think about these assets as the real store of value assets on the planet. And we need to change economic structures to start to think about how we long-term invest in them and incentivize people to protect them. So my journey towards ESG and more importantly to sustainable finance is really that I think there has to be an awakening for society that we need to rethink economics to look after the most important assets on the planet. Sorry for my long explanation, but I was trying to animate as much as I could.
I loved your closing sentence there, Richard. That was fantastic. Devina, tell us about your journey to the space and what you're doing with Zumo and 013.
Sure. So we, when we started Zumo back in 2018, we always went from a compliance first and a sustainability first perspective. And actually, it's really interesting now, in the market, we are seeing this intersection between regulation and sustainability, which I think is a really important part of our journey. I think, as I mentioned in my introduction, the genesis of our work came through our own net zero journey. How are we going to achieve net zero by 2030 as a business? And at the same time, with our enterprise solution, we were going out to institutions. And as you all know in the room, institutions all have a really significant ESG mandate. And it was a bit of a blocker, right? Because at that time, when we were first speaking to them, there was so much in the press about the energy consumption of crypto assets. Obviously, a lot has changed since then. But what we realized is actually through our own journey, we had built this, we were able to build something that we could productize that allowed for this measurement and reporting and also how to address the carbon impact of digital assets. The thing that we're working on at the moment is Mika. That's we have our product Oxygen, which is focused on this. But actually, in the immediate term, we're focused on Mika, which is the markets and crypto asset regulations coming into the EU to harmonise crypto asset regulation across Europe. And the thing that we're coming up with again and again is that, especially where it sits, which will be, general counsel or in with chief compliance officers, the lack of awareness that actually one of the 8 or 10 reporting requirements as part of Mika is on sustainability, and actually the awareness of that is quite limited, and we're constantly having conversations with people to whom this is news. So that's what we're working on, making sure that our Oxygen product actually can fit the Mika reporting framework and, just tick that box in terms of, because I guess if you're a chief compliance officer, sustainability is not going to be your A strength, it's not going to be your focus. So to have someone that can help you just tick that box, I think is really important.
Thanks. And Victoria, I've told a bit about your origin story, but tell us what you've been doing since you abandoned tokenized IP.
Okay, so my journey in this space really even goes back a little bit further than yours. So I had the joy of working in Asia for a few years, and I used to be head of innovation and tech ops, legal and compliance for the Development Bank of Singapore. So I had the joy of learning about what the power of tokenization and blockchain technology could do back in the early days, working with a large amount of the experiments that they did in this space, the early origins of Project Ubin and all of those. And I helped set up Climate X, which is kind of like probably one of the well-known carbon trading platforms, and the spin-out that the Development Bank of Singapore launched with the regulators out there for carbon markets in Singapore. And when I came back to the UK in 2018, I was a little bit sad because I met up with my old friend Nick Davey, who's up there, when I used to be inside Treasury and Cabinet Office as just a private practice lawyer. And I'd been inside Barclays before I went to Asia, and we were working on a report for Lord Holmes that talked about DLT and the potential for for the public sector and what this technology could do and infrastructure, if it existed, could do for the UK. And we kind of lost our way, gone down a bit of a Brexit rabbit hole. And so when I caught back up with Jeremy Wilson and was back at Barclays as head of innovation advisory there, trying to move things forward, I got involved in setting up Unreasonable Impact, which was their CVC investment into sustainable businesses. And I basically lost and fell out of love with Barclays. And when their chief innovation officer and CTO left and got given 200 million to go and play with BlackRock, I said, right, I'm off. And I parlayed what we did with Lightning Aid into £500,000 worth of grants from the UK government to investigate how digital infrastructure could help with risk and mitigation finance. Because this is a major issue. We need to be investing trillions in supporting economies around the world that are going to be impacted by climate change. That led me all the way to COP28, where I presented this on the sustainable finance stage. And I've been now working with a number of African nations and development banks to think about this, to the point that this week I've taken time out from working with the Saudi government, who are interested in these ideas of how that can help grow their economy and also support them in their ecosystem and what they want to produce with preserving the Red Sea and all of their environmental sort of challenges that they have out in the Middle East, because it's getting hotter and it's getting a bit difficult to live out that way. And plus of all of the natural disasters and things that are coming more with climate change. So that's what Orora does, really. We help people figure out those programs and those issues, and working with them at that intersection of legal and regulatory challenges. And in my spare time, I try to lobby as much as I can for the UK government to care about this, because when you break down what ESG is, traditional banks have really got their head around what the EBIT is. They understand how to finance the kind of like energy transition and the large infrastructure finance, albeit that's still all paper-based and very painful, and the compliance is always out of date, and you're relying upon paper policy and paper data to come back to prove the product is doing what it says. But the S and the G we've really not thought about. There's very little taxonomy, there's very little metric and regulation around that. The EU is light years ahead because they have a very strong social bond market. In France, for example, the biggest social bond in the world exists, which was issued by the French government for 5 billion. That's how they fund their schools, their hospitals, and large of their Marie communities and everything that they do in France. It's huge. So Crédit Agricole, BNP Paribas, and a large amount of those European institutions are ahead of this game. And they are really investing in these kinds of platforms and tokenization because they see it as an opportunity to comply with that. And also in the EU, we're quite far ahead on the legal and regulatory landscape for these potential products in the capital market space, which I think is great. But UK could really, really do something here that would be meaningful, hit all your lovely targets that you've got with your policies that needs to come out, could be a huge growth agenda. And what we always have in the UK is the shining star that our legal and regulatory system and the global financial sandbox that we have here and the new sandboxes that we have with the FCA and the Bank of England, we could be that trailblazer and really help with those nations that need these products and need the confidence that you can invest. Because that's the problem. If you can't trust the financial systems and what's happening, this is what these types of products and services can. With near real-time reporting, I'm not going to be deluded and think it's real-time reporting, because it isn't. But it's better than what we've got with paper, and it can give people opportunities to access finance in a different way, both at an institutional level and at a citizen level.
I think that's a really nice segue, Victoria.
I think we should go now.
Yeah.
Into the drivers for adoption of these technologies across the financial sector more broadly, because of course it would be nice if, you know, all financial institutions were altruistic and adopted ESG, transition finance, sustainability objectives out of the goodness of their hearts, but that's not quite how it works. It was really central banks in recent years waking up to the fact that climate change, for example, and a lack of sustainability in finance poses financial stability risks that led to the slew of regulation that is now impacting the entire financial services industry. So Kikun, it would be great to hear from you a bit of background on some of these regulatory drivers and some of the challenges that you see your clients facing in compliance with them.
Thanks. I think coming out of the back of the financial crisis way back in 2008, we saw a whole swathe of financial regulations come onto the books. And that sort of created a compliance burden for market participants. And one of the key things, one of the key pillars of all the new rules was the need to improve governance. And of course, governance is the G in ESG. So we've really seen clients embrace, or at least be proactive in investigating all the ways in which DLT can support them in their regulatory compliance. So in particular, in the area of automating some of the data collection, having transparent ledgers from which those data can be collected and they can be reported and audited and sort of risk assessed in order to feed and report adequately. We've seen new regulations and directives, especially coming out of the EU. For example, the Corporate Sustainability Due Diligence Directive, so CSDDD, which will require in-scope companies to carry out due diligence across their entire global supply chains and take action to remediate any breaches, to prevent any harms. And if they don't, they can be fined up to 5% of their global turnover. So that creates a headache of, well, how do we monitor supply chains that can span in pretty much the entirety of the globe? So we're seeing products and solutions coming onto the market, which is doing just that. So these are based on and built around blockchain technology. They allow for data to be entered and monitored in real time and allow for the early detection of issues. We're seeing companies gather metrics in respect of things like compliance with relevant ESG and sustainability standards, gathering data in respect of local labour practices and the sourcing of materials, and using that data to effectively have a near real-time understanding of that widget that's been shipped from, I don't know, the Congo. How are the processes around that transportation compliant with the sort of the reps and warranties that I'm giving to my investors, to the disclosures I'm making to the market, to the regulator in respect of ESG compliance. And on the other end of the spectrum, we've seen more, I guess, not trivial, but more things that are resonating more with the marketplace. We've seen Premier League football clubs, for example, issuing fan tokens with a view to allowing for their communities to participate to the extent appropriate in elements of their governance. So again, these fan tokens are issued on blockchains, and they could be traded on blockchains, and we're really seeing uptake and interest in that area, and sort of supporting a lot of the infrastructure. We're advising crypto exchanges on the categorization of the assets, of the digital assets that are traded on their platforms. I think we're all familiar with the need to make sure that these assets are not securities, and if they are, to make sure that compliance is appropriate with relevant securities laws. And we advised the European Investment Bank on the issuance of their first euro-denominated digital bond, which was issued on a private blockchain, and has many of the benefits that you mentioned at the top in respect of using smart contracts to enforce compliance with relevant requirements and criteria and use of proceeds type criteria that are published in the offering documents. So I think the drivers are twofold. There's an element of needing to comply, and these applications and solutions are genuinely useful in that endeavour. And then there's the more exploratory drivers. Now that we're here, what else can we do? What other products can we design, can we launch in order to hit some of the social goals? So financial inclusion is a big one. Governance is a big one as well.
And I want to also address one of the kind of elephants in the room with these discussions, which is the use of blockchain itself. People will often, say, how can you talk about sustainable digital finance when the underlying technology itself is not always sustainable, necessarily in nature? So while we are seeing a shift in public blockchains to proof of stake, it's still an incredibly energy consuming technology in many cases, particularly on those blockchains that are still proof of work. General thoughts from the panel. How do you address some of these challenges to the premise of the technology and its use in this space?
Can I offer a thought? So firstly, I think we have 1,000 blockchains in the world today, and 26,000 tokens. So I think Johnny Fry on the panel in the morning commented on, we're more fragmented now than ever before, and this was not the intention of this technology. I'm an electronics engineer, communications engineer by background. When you really look at the engineering, there are only two formats of blockchain. It is a proof of work UTXO chain, or it's a proof of stake account-based ledger format. And both of those have got pros and cons. On the proof of work UTXO side, that's best known as Bitcoin, but there are actually 14 implementations of the Bitcoin protocol on the planet. So unfortunately, in the way that we understand Bitcoin through the press of BTC, we know that that technology has a very large mining footprint, a lot of hash power, and a very, very large energy consumption model behind it. And the Judge Business School, the Cambridge Centre of Alternative Finance, does a fantastic job of tracking this asset or this infrastructure and documenting its daily consumption. And they also do the same for the Ethereum base layer. So that on the UTXO side, we have networks that are actually 98% more efficient than BTC, and they are utility networks, therefore running e-money, and they're running transaction processing. They have very small mining footprint, they have larger block sizes. So I think presently we're on a discovery of trying to make sure we elevate understanding of what are we talking about. We all throw the language around so casually, but unfortunately it is not a universal label. That there is some significant differences in this technology. And on the proof of stake side, account-based ledgers, they run in cloud computing models mostly. They don't have dedicated mining machines like ASIC machines on proof of work. And there's pros and cons to that. But unfortunately, those networks do not process many transactions, so we've seen the rise of a lot of layer 2 scaling networks to try and compensate for the lack of processing of the base layer. And that has generated an even bigger footprint on top of the base layer 1 Ethereum. So my first set is, there's a scene set. We have too much technology. There is going to be mass consolidation over the next 3 to 5 years, but we now need to try and really find ways to let the power of the engineering of the technology emerge and really see it through international standards. And that's going to take us a little bit longer to make sure to get there. That's not going to happen quickly.
Devina.
Yeah, the only thing I would add to what Richard said is, I think there needs to be, especially in the case of CBDCs, it's about striking the balance between, the accessibility, how you manage it, the type of ledger it's on in terms of the energy consumption. And, the future of money and financial systems, climate change is going to be embedded into it because its impact, whether it's real and physical through climate change itself, one-off events like hurricanes and things like that, they are all going to impact the financial systems more and more. And then the internal factors like, governance, regulation, and behavioural changes. But I think one thing that's really important about the technology is how auditable and trackable it is. So you are able to measure the energy consumption, and I think that's a really important point about, you know, about being on the blockchain, which you can't do in traditional finance. We can make estimates, but I think once you have that data and you understand the energy consumption, you can take steps to address it.
It's a great question here. In terms of the different forms of digital money, how could each of these help drive the sustainable finance agenda? And of course, when we're talking about new forms of digital money, you know, there's quite a spectrum. There's wholesale and retail CBDCs, tokenized deposits and tokenized e-money, stable coins. What are each of you, you know, which forms of digital money are each of you seeing being used actively in use cases and applications at the moment?
I mean, in the projects that I work on, it is very varied. I mean, I wrote the operating manual for Goldman Sachs' DAP platform. I worked on the tokenized gold platform that HSBC were doing. In all of those, you have a quasi-synthetic CBDC, stablecoin type mishmash. And we're kind of, don't know what we're doing right now, but we're still trying, which is quite sad that we've been in that loop for as long as we have. But I think, again, it comes back to the regulatory landscape and the clarity there. Because it's not about what you can do, it's about how it's judged and how it's treated. So I think the more clarity we have on that space around taxonomy and the use cases and the greater engagement that institutional and fintechs and those innovating in this space can have with regulators to inform that development and policy development, the better. And for the growth in that industry, for the investors in that industry, it's huge. But one thing that I'd really like to say from my time in all of these projects is there is a huge investor community that wants to invest. Right from the individual citizen all the way to institutions at a sovereign wealth level. There is a market opportunity here that is vast. And they don't care about what form of digital money. They don't care about what technology is used. They want product. And I hope in a few years' time we're sat on a panel talking about product and how we're helping people rather than at this level, because I think that's really important. Because a stablecoin or a synthetic CBDC, they can really do similar things. So what investors want, what consumers want, and there's another question on this there. I mean, that's what we want. We want our money to have value. And that's ultimately, whether it's a stable coin or a CBDC, it can really do. It can give value and purpose, and you can show and share that purpose through this technology. And that's what ESG should really be about.
Out of interest, in practice, the work you're doing at the moment on digital carbon credits, and you know the work you're doing with the same kind of space, Devina and Kikun, with your clients, how are they actually settling these transactions? What settlement assets are you using today?
So in the voluntary carbon market, it's also fragmented, meaning it's either fiat currencies, most trade in US dollars, really, and that market is very much an over-the-counter broker-facilitated market today. It's really bilateral. Where it has been digitized, it is running through probably anything up to 10 different blockchain formats. So we've got token protocol interoperability problems, we've got blockchain interoperability problems. So you're seeing the rise of a number of, you know, bridging companies and hub companies that try and provide that interoperability space. So we're putting more friction in the system is the honest answer. And for an asset class like voluntary carbon, where we have an urgency, a critical urgency for 2030, we should not be putting friction in that system. This should be a digitally native asset class, and we should be collaborating around strong standards that really enable speed of action for global society. So I think presently, a lot of friction.
Yeah, but just to add, I think I agree with that. Where I'm seeing probably the majority are still settlement in fiat currency. But I just wanted to come back to a point that, Victoria, you made around digital assets' potential to help maintain value. I think it's sometimes difficult to sort of see that live in action in the West and the UK, where on the whole, we have stable currencies. But with some clients in developing countries, you can have a situation where, you know, in 1 year, your unit of currency is worth X, and the next year it depreciates by 50%. The ability to be able to store your value in a stable coin that's pegged to the dollar, that you can access through a distributed ledger at any time, and you can, you know, on-ramp and off-ramp back into relevant fiat currency as needed, is a really, really important aspect of financial inclusion in solving some of the biggest challenges on a global scale, not just in terms of digital assets on its own. So it's a really, really important use case applications, and we are seeing clients investigating and exploring, you know, launching and designing stable coins for these very reasons. I think if you were to look across the world at where the greatest number of big cryptocurrencies are held, I think it's in somewhere like Nigeria for that very reason. The instability, the economic situation drives people to want safe havens for their value.
Then now we've seen in those nations, particularly Ghana, Nigeria, where they're now taxing that.
Exactly.
So there's a 25% tax on digital currency now, specifically that for a reason, because of the flight that it's taking from fiat.
Yeah.
So the likelihood of that type of solution getting to scale and having that traction, I think, is now being very much squashed. So specifically in the Africa Free Trade Agreement and the harmonisation of financial regulation across Africa, that is a very specific point that they are looking at in that regulation, because they do not want the reserve currencies of the world to come in. And they've had that experience with what China and the digital yuan and what they're trying to do there. So there is, again, an opportunity through the Commonwealth and through engagement with local central banks and the proof of concepts they're doing, and to grow their own ecosystems to build that currency stability. And I think that would be more powerful in the long term than a flight to the dollar or the pound or the euro.
Yeah. And I think the reason for that tax was, so the Nigerian central bank issued an e-naira, so one of the earlier CBDCs, and there was very, very low adoption for all kinds of reasons, I think largely based around trust. And so in order to sort of stop the adoption of other stable coins, other digital currencies, we've seen measures such as these.
Yeah, well, it's like in Ghana, for example, it's over 25% of the GDP of a nation is transfers in.
Yeah.
So it's huge.
So we've got just a few minutes left, and to end on a controversial note, a question that's been upvoted a couple of times. Peter Thiel, the PayPal founder, likened ESG policies to the Chinese Communist Party. Is it possible to drive sustainability without top-down government approach? So question to all of you, and given we have 4 minutes left, great if you could keep responses short. How do we make people care about this? You know, how do we get that grassroots engagement from the individuals in this room, for example? How do we make people care about it enough so that it's not just something that's driven by regulatory requirements and by penalties, but actually something that's, you know, embedded in what people want and, you know, lobby for every day? Davina, I'll start with you.
I think it goes back to what I was saying. I think regulation is going to be the driver in the first instance. I think things like behavioural change are happening, but they're going to take time. We have voluntary carbon markets. We've got kind of very embryonic voluntary biodiversity markets as well, but they're voluntary. And actually, that's not, you know, you'll only get scale, unfortunately, through some form of regulation, which is going to drive demand. So I think also to kind of try and politicise climate change, I think, is a bit of a strange thing to do as well. I think, you know, as I said, climate change is going to impact our financial systems through various ways, through events and through regulation. So I think, for me, I think regulation is going to be important because right now, voluntary is too slow.
So we need the top-down approach, is what you're saying. Kikun.
I'd agree with that. I think the top-down approach is really needed where the case for what it's not, people don't deem it to be a necessary thing. Where there is an imperative to adopt something, you have quick adoption. Example being during COVID, we all became experts at teleconferences, and now I can't imagine a world where we go back to phone calls. So I think unless there's an event, an act of God type event that drives adoption in that way, I think we will need to, it's twofold. I think there's the top-down approach, but then there's also the case of the industry making the use cases and demonstrating the utility and the benefits and the efficiencies, much in the way as we're seeing the case being made with AI currently for better or for worse.
Richard.
Yeah, I think unfortunately also it needs top-down. I think society doesn't demonstrate it can self-regulate and do the right things well enough often. But equally, in this journey to net zero and removing 50 gigatons of greenhouse gas from the planet by 2030, for most humans, that's a really big boulder, and I don't know how to solve that problem. So how do we break that down into small pebbles? And I have 3 children, and I use them as an example, which is when I need them to recycle in our home and turn the lights off in all our rooms, you know, I have to find incentives. And so people respond to incentives. And this technology we've been talking about today offers the ability of a micropayment system, and the fact that why don't we have a smart citizen wallet, where my local council rebates me part of my council tax for the volume of recycling I've done, for the green energy I'm consuming, for the fact that I've traveled on biobuses. I could animate my behavior, and I could get incented for taking the right behavior. I think we have got to try and make this a lot more tangible on a daily basis. It's not tangible enough yet.
So two sticks, 1 carrot so far. Victoria, I know you're dying to have the last word, so please go.
I think it's got to be a bit of both, like it is with both things in life. You need the incentivization from regulation to stimulate it and to get it to enterprise scale. But I would look at what Lord Bird's done with the big issue and the big exchange. They've created an ESG ISA. They've created a whole product and a market that's been absolutely amazing about helping social enterprise, investment into impact projects throughout the UK and globally. If there is a good product, it will fly. And what we are desperately missing in this space and in this industry is really great product, because unfortunately we're still stuck in an engineering community figuring out the tech. And if we get to business managers and get to working out how people can make money out of this and building products that people want to buy, this will fly. So that's what we need. Real innovators that can build product.
Thank you for being a fantastic panel. Hope you all enjoyed that.
Thank you.
Great, thank you.
And thank you to Jeff for having me.